What happens when a single political move exposes how fragile the global financial system already is? That question is spreading rapidly across markets, government offices, and trading desks because a new wave of political pressure tied to Donald Trump has collided with an already unstable economic environment. Reports indicate that a recent move connected to Trump's legal and political positioning has triggered a sharp reassessment of risk across global markets, not because of the action alone, but because of what it signals about deeper systemic stress. This story is spreading now because financial institutions were already on edge. Debt levels remain historically high, interest rates are still restrictive, and liquidity conditions are tight across major economies. When Trump re-entered the center of institutional conflict through escalating legal battles, public threats against regulators, and renewed pressure on trade and monetary policy narratives, markets interpreted it as a catalyst rather than an isolated event. Investors, central banks, and governments are reacting to the possibility that political instability in the United States could accelerate existing financial fractures. What appears to have triggered the latest shock is a convergence of events rather than a single announcement. Court filings, campaign signals, and statements from Trump aligned with renewed pressure on the justice system, the Federal Reserve, and international trade frameworks. Sources familiar with internal discussions say global financial institutions are watching whether these moves could undermine policy continuity in the world's largest economy. Even without formal policy changes, the uncertainty itself is driving volatility. It is important to separate what is confirmed from what is being claimed. Confirmed developments include intensified legal proceedings involving Trump, increased political polarization in Congress, and renewed rhetoric around tariffs, central bank independence, and executive authority. Filings indicate that some regulatory agencies are preparing contingency scenarios in case political pressure escalates. What remains unconfirmed are claims that immediate policy reversals are imminent. Officials have not announced changes to interest rate policy, trade agreements, or capital controls, but markets are pricing in higher risk premiums based on perceived instability. The broader system under strain did not begin with Trump. The global economy is still absorbing the aftermath of aggressive rate hikes, pandemic-era debt expansion, and fragmented supply chains. Central banks have been attempting to balance inflation control with financial stability, while governments struggle to finance deficits without triggering bond market stress. The Treasury is issuing large volumes of debt, foreign buyers are more cautious, and domestic demand for bonds is sensitive to political credibility. Trump's role in this environment functions as a pressure point. His reemergence intensifies questions about institutional durability. Investors are asking whether courts can operate without political interference, whether Congress can pass funding bills without crisis, and whether the Federal Reserve can maintain independence under renewed public attack. These questions matter because global capital flows rely on confidence in American governance. Recent developments have altered the balance of power in subtle but important ways. Filings suggest increased coordination between political actors and legal strategies that could delay or disrupt normal institutional timelines. Officials signal concern about prolonged uncertainty heading into major fiscal decisions. Trade authorities are monitoring whether rhetoric could translate into renewed tariff threats, which would complicate global supply chains already under strain. Foreign governments are reportedly reassessing exposure to U.S. assets as a precaution, not a rejection. Global shockwaves are being felt because the United States sits at the center of the financial system. When uncertainty rises there, Currency markets react, bond yields move, and emerging markets feel pressure almost immediately. Reports suggest that some central banks are quietly adjusting reserve strategies, reducing sensitivity to dollar volatility. This does not indicate abandonment, but it does show a shift toward caution. The Federal Reserve is now in a difficult position. It must project stability while avoiding political entanglement. Officials have emphasized data dependence and independence, but the backdrop makes every decision more sensitive. If markets believe that political outcomes could influence monetary policy, credibility risks increase. Even the perception of interference can tighten financial conditions without a single rate move. For households and businesses, the danger lies in second-order effects. Higher volatility can raise borrowing costs, weaken investment, and slow hiring. Banks facing uncertain regulatory environments may tighten credit. Pension funds and asset managers may rebalance towards safer assets, reducing capital availability for growth. These are gradual pressures, not instant collapse, but they accumulate. Wealth inequality and middle-class stress amplify the risk. When political shocks interact with economic fragility, social pressure rises. Officials are aware that consumer confidence is vulnerable. Any perception that elites are insulated while households absorb the shock can deepen instability. This is why policymakers are cautious with language, even as internal risk assessments grow more serious. What could come next depends on whether political pressure escalates or stabilizes. If legal and institutional conflicts intensify, markets may continue to price in risk, leading to sustained volatility. If clearer boundaries are established and institutional processes hold, some of the panic may ease. However, the underlying economic challenges remain unresolved, including debt sustainability, fiscal discipline, and global coordination. Global institutions are watching closely. International financial bodies are monitoring liquidity conditions and cross-border capital flows. Trade organizations are assessing the impact of renewed protectionist signals. None have declared emergency measures, but preparations suggest heightened alertness. The key point is that this moment is not about one person or one decision. It is about how fragile systems react to stress signals. Trump's move acted as a trigger because it touched multiple fault lines at once: legal authority, monetary credibility, political stability, and global trust. When those lines intersect, even small shifts can produce outsized reactions. The situation remains fluid. Officials urge calm publicly while preparing privately. Markets swing between relief and fear. No definitive outcome has been reached, and no final economic judgment can be made yet. But the reaction itself is a warning sign. The question now is whether institutions can absorb this pressure without cracking, or whether uncertainty will continue to compound. History shows that financial systems rarely break from a single blow. They weaken when stress tests keep arriving faster than confidence can recover. That is the uncertainty now facing the global economy, and it is why this story is unfolding in real time, with consequences still forming just ahead.